What's up? This is Mandalo, and in this video I'm going to show how to identify a feature known as poor highs and poor lows. And TPO is the best tool for this. For this video I'll be using my TradingView setup for simplicity and its availability, but there's lots of other programs you can use with TPO tools. For those only watching videos, for the quick answer, poor high and poor low is found in TPO profile at highs and lows if there's less than 2 unpaired TPO blocks or letters at a high or a low. Unpaired TPOs are called single prints, and at a high or low, it's a single print tail. If there's less than 2 unpaired TPOs at a high or low in a profile, it's considered to be poor. To actually understand poor highs and poor lows, though, it's important to understand a few things about TPO. TPO is a time-based way of studying market structure, and instead of volume, it's based on time spent at specific levels in a daily session. Default settings for most traders commonly using TPO is 30-minute periods with a new profile each daily session. So this is one day, another day, another day. TPO can be used for different time periods, but we're going to use daily sessions for poor highs and poor lows. New TPO letters or blocks will be formed each 30-minute period within a daily session, giving every profile a unique signature for the day's price action. In each 30-minute period, wherever price trades, new letters or blocks will form, representing that 30-minute period of price action. These blocks are usually a default size for price increments, and it depends on the tool that you're charting with, but this can be adjusted by selecting ticks per row in your settings. I'll have another video on this soon, but in most charts in this video I've selected between 24 and 48 TPO height for Bitcoin, and this chart is set to $34. Poor highs and poor lows represent unfinished or incomplete auction within a daily session. This can also be called lack of excess. Excess in candlestick charts are observed by presence of buying or selling tails at tops and bottoms in the daily session. The more excess, the longer the tail or wick. This is a strong reaction by buyers or sellers, and it often causes price to move in the opposite direction, at least in the short term. TPO helps us to identify excess by number of TPOs at a high or low, and quantify the amount of time spent around the highs or lows of a session. The more excess, the longer the tail or wick. These single print tails mean that price traded at a higher low during only one 30-minute time period in daily session. The more single prints or single TPOs at a higher low, the stronger the excess. If there's less than 2 single TPOs at a high or a low, it's considered to have lack of excess and can said to be an incomplete auction. There might only be one. There may be no single TPOs, and it might be a larger row of TPOs, but if there's lack of excess, it's considered to be poor. Price might trade away from a poor high or low in the near term from exhaustion or absorption, especially if it's during trending moves or at the end of a trending move. but poor highs and poor lows have a high probability of being revisited to repair this unfinished auction. And it's usually within a daily session, or at least a few days, to repair this lack of excess. Sometimes these retests result in a fast reaction and a poor level will be swept or swing failed in a single wick. Sometimes these poor levels will be traded through and a more expansive move can result. So like here, poor high, traded through it, and a pretty expansive move. And really that represented about $5,000 from this level. Why we look to identify poor highs and poor lows is they can provide targets to trade towards, as highs or lows of a session are a common area for traders to place stop losses. So let's say we're looking at right here. This is during a daily session. That's the same place, and it was 1, 2, 4 touches in a real close area. And that's how it was appearing as it developed during the daily price action. And ultimately, that level broke, and we kind of nuked from there. So why does this happen? Well, highs and lows of a session, or highs and lows in price action, are common places for traders to place stop losses. And lots of liquidity is usually resting beyond these sites. So here we have price moving up, poor high forms, and price wicks through, repairs that incomplete auction, and trades back down. Now it doesn't result in a trend move, but in an intraday, that was a pretty nice trade. Okay, but what happens right here is we begin to flip this level, push up, and a poor low is formed. Another poor low. And we came back and repaired it. So poor highs and poor lows are helpful to identify areas of interest, but should not be the fundamental of your trade thesis. As you can see in this zoom in right here, we had a poor high, another poor high, and price traded away from them. So that's another feature of highs and lows that we'll talk about in a later video, but what we had was called a failed auction at this level. So what do we do if a poor high and a poor low forms in a daily session or within a range? How do you trade that? Like, what does this even do for us? Well, make a plan for either direction price might break. Don't trade the breakout counting on this breaking. As you can see, traders have been building positions through this whole level, and when that low broke, price continued down. So have a plan for either if you have that. Really, it's best to have a plan for anywhere the price might move if you plan to trade it. And sometimes it's helpful to zoom out. So you see that's the high, that's the low that we just identified. And price moved down expansively. But this looks like a bullish trend. Why didn't the highs break? Well, we just moved up expansively, like 10% in a couple of days. 1, 2, 3. So what would say that we wouldn't have continuation? In the daily trend, it looks pretty good. But over the past few weeks, and this is over a month, we really have been in a downtrend. So, zooming out can give us perspective. If I zoomed out to the monthly trend, we've been in an uptrend. This is a tool to identify setups and areas of interest. It's not a way to guarantee trades are going to work out. These are areas of interest, and no one indicator can predict the future. We're just trying to increase our probability of success. Now, the last thing is sometimes a poor high or poor low can represent like a double top. Sometimes within a daily session, so this is our daily session, this is a previous day, but these are at the same level. There's your double bottom. This is a double top, but if you are relying just on market profile, it's not going to point out that particular feature. So that's a high, that's a high, it looks good, but it's the exact same level. So why didn't it break? Well, TPO isn't going to tell us that. So it's not a guarantee. Splitting up the TPO sometimes can help and see those poor levels a little bit more easily, especially if we have areas of price within more than one daily session. And here we have a different amount of ticks between this chart and this chart. So with larger tick size, you see that price traded within this area for 30-minute sessions, and this one only 2. But still it's poor. They're around the same level, and that level did end up breaking, as we saw in this chart right here. Alright, so in my next video we're going to look at some more examples of highs and lows, using poor highs and poor lows, and other examples of high and low structures, and talk about more trade setups that focus on these levels. Thanks so much for watching. Please like and subscribe and share if you think it's helpful. Good luck, and see you in the next one.